always, we like to get things kick-started with the asset class returns. Now, what's unique about these returns is not only am I showing you how things went in December, but also for the full year now of 2021. Large caps, again, had a great month of December. It started off a little rocky if you guys were watching the week by week on the markets, but it ended up with a pretty strong finish. So large cap stocks up over 4.4%. And for the year, over 28%. Pretty darn good year for 2021. Small caps did almost as well, up 4.53 for the month and up 26+% for the year. Now, the winner of it all was real estate. Real estate finished off very strong, positive 10% for the month. And as you can see here, above 46%. For the year. Now, that might be changing a little bit next year because one of the big concerns is interest rates starting to look like they're moving up a little bit quicker as the Fed starts to become more conservative. So we'll see if that trend from the last few days continues. International stocks also did pretty well. You could see 4.89 for the developed markets, actually a little better than even the U.S. markets. But didn't do quite as well for the year, only up 11.38. Maybe that's a trend that's starting to reverse in international side. We shall see. I know we've been talking about that for a long time, and it hasn't completely come to fruition. So, so obviously something that you have to really wait and see. Emerging markets, pretty lousy year actually. A lot of that was because of China. And really because of COVID. But China's, not only have they suffered through COVID, but they've also been going through a lot of regulation changes that have affected their markets negatively, at least in the short term here. And for bonds overall, like the higher quality type bonds, bonds ended down a little bit for the month and down a little bit for the year. So interest rates were starting to move up a little bit. Strong economy. It didn't help the bond market. High yield, though, did a lot better. You can see up about 1.5% for the month, which is a pretty good month for bonds, and up over 4% for the year. So pretty good year overall for high yield bonds. And of course, commodities did really well too with the concerns of inflation and all. So up 5.8 for the month and over 30% for the year. And thankfully we had exposure to all these areas that did very well. We were actually underweighted in fixed income and a little overweighted in stocks, and in particular had good exposure to real estate. So thankfully we were able to participate on some of these overachieving areas. So those are the asset class returns for 2021. So in the month of December, one of the biggest concerns that we all had was COVID and the new variants. And of course, we learned a little bit more about Omicron this month. And I wanted to show you this chart. It's I know it's a little small because it's it's right there. But what I'm trying to show you here is the orange, and these are the ICU beds. Now, we all know that Omicron has had many, many more cases than we've seen throughout all the variants, Delta and all the previous versions. So this is what's mostly highlighted in the news, right? And the good news is you can see here in the orange, this was the Delta wave. These are some of the previous waves. The hospitalizations went up. The COVID ICU beds, which is this chart here that I got from Johns Hopkins. And you can see how it's gone up a little bit, but really not that much more. It's a little bit smaller even than the Delta wave. So what's interesting is we have probably 5 times more cases, but we're not seeing 5 times more hospitalizations. So in other words, it looks like this variant is starting to show some signs that it's not as lethal and it's not putting as many people into the hospital. For me, what this means is there's going to be less emotion that's going to be attached to this variant, and possibly this is a trend of what we are to see going forward with the virus. A lot of experts, much smarter than me about virology, say that this is kind of the trend of these types of viruses. And so if that is the case and that emotional impact starts to go down, that also means that there's going to be less shutdowns, there's going to be less disruptions from the virus. So this is all very good news for the economy, very good news for health and all those poor workers there at the hospitals, hopefully. So this is a very good piece that I think is a reduction in the potential risks we were thinking about for December. And then the other big concern that developed a little bit more in December was how the Fed was making this big pivot. And I talked a little bit about it in November, but now we're getting even more information from the Fed. I wanted to show you this chart to kind of explain what the Fed is trying to do and what I feel is going to be kind of a predicament for them. So what we're looking at here, this is the Fed balance sheet. This is all the bonds that they buy from the open market and basically collect on their balance sheet. Now, you might need a quick review. When the Fed buys bonds, they're basically creating money out of thin air, okay? And so this, in essence, is a chart, which is of the balance sheet, of how much money has been printed out of thin air. And so as you can see, more and more money has been printed, and you can see right here, this is when the pandemic hit, which kind of accelerated that, what they call quantitative easing, even more. And so what the Fed said and back in November, and they gave us a little bit more information here recently, is that they want to, first of all, stop this acceleration of the balance sheet. That's what they're talking about when they say that they want to start tapering. Okay, so that by itself, a lot of people think is a good thing, because that means that they see things getting better and they don't need to have this emergency type of situation anymore and continue to buy bonds. That's why you see this chart here shows the forecast of flattening out. But the new piece of information that came up just a few days ago, which really kind of rocked the markets a little bit, is they also plan not only on raising interest rates, okay, which is the other thing they could do, but in regards to this balance sheet, they want to actually bring it down, okay? And so it'll be interesting to see how they do it. Are they going to, let the mortgage-backed securities or the treasuries, that'll affect things a little differently. But in general, reducing this balance sheet is basically taking money out of the economy. And so I think that's going to be pretty challenging to do. But it is a positive sign that they want to do this. But I would say it's also a negative sign because they're getting more and more concerned about inflation. This was not something that too many people were expecting them to say, which makes us feel that maybe they're more concerned and they got a little bit behind the eight ball on inflation than they thought they would be. So interesting to watch. Okay, so what does this all mean to you and your investments? Well, I think what we're seeing right now, for the first time in a couple of years, we're seeing a little bit of a change in the narrative of the market's risk. So before it was all about COVID, and whatever was happening to COVID was going to determine how the economy and the markets were going to go. Where now I'm starting to see a little bit of a shift where COVID is still a concern and it's going to have a little overlap, but it's going to be more about the Fed. Okay, and that's why I have this this funny picture here that says "Don't fight the Fed," because now the Fed is very concerned about inflation. They're trying to tamp it down. They don't want it to be a big problem. They want to try to catch up because I think they feel like they're a little bit behind. And in doing so, they're going to start to do measures that are going to maybe slow the economy down potentially. Now, the big question is the economy strong enough? Is everything going well enough to sustain this quantitative tightening, which is kind of the forecast of what could potentially happen from the Fed? That is the big question. And the essence of what I want to share here is that I want to let you know that I'm going to start focusing a little bit more on that. Of course, Omicron is still a problem. It's still going to affect Q4 and the numbers that we start seeing here and potentially even into this first quarter. But I think it's starting to dissipate and it's going to be more about the Fed. Okay, so in the last slide here, I wanted to talk a little bit more about the investment implications for 2022 and how this change in narrative is actually going to play out. And so we still have the virus. It hasn't gone away. The hopes is that it's going to start to diminish in its importance and its impact on the economy. But unfortunately, it's still going to have an effect on the numbers we see from Q4 and possibly into Q1. And then in addition to that, we have the Fed that's jawboning, right? They're trying to, talk the market into letting them know that we're going to be raising rates. We're going to start getting more hawkish with our policy. And all those things combined are still going to make it pretty tough for the market, I think, for the first several months, maybe even the first full half. We're also going to see those inflation numbers that are going to still be pretty high. Maybe they'll peak here in the first quarter. We will see. But in the second half, I think what's going to happen is you're going to see inflation is going to start to moderate a little bit. The Fed is going to start to backpedal a little bit as well in their strong language that they've been using. The economy is going to continue to be pretty strong. The corporate earnings have been very good. Now they're slowing down, but remember the previous year they were super, super high. So it's hard to keep up that super high level. So it's just going to be more of a high trend, which is still very, very good. So I think we could finish off the year, especially if the Fed kind of backpedals a little bit from their strong language. And then, of course, has a lot to do with the virus and if inflation can start to tamp down as well. So what I'm asking you here is this is going to probably be a year that's going to take a little bit of patience. I'm not making a lot of big changes other than I'm just making sure I have good inflation hedges on the portfolio, making sure that I'm doing the rebalancing a little quicker and not being too overexposed in the market, especially here in the first half. So I just ask you to have a little patience. This is going to be a little tougher, especially the first half of the year, but with a little patience, especially since we don't know exactly the timing of these things, we could still have a pretty good year for 2022. Thank you very much.